people who are using HELOCs to buy their new house?
Yes. So, first of all, if anybody is unaware, a HELOC is a home equity line of credit.
Might need to sell them that.
And what a home equity line of credit is, it's pretty much a second. It's a revolving debt based off of the first mortgage of your house. So you already have a mortgage on your house that you bought your house with. The HELOC would be just like you're using a credit card at the store. It would be just the same. So the equity that you have in your home, they would allow you to take a loan out on that equity and use it just like a credit card. So say your house was worth $300,000. That $300,000 would be up against, say, your loan amount would be $150,000. They'll let you borrow up to 90% of that $300,000 in a home equity line of credit. And what that does is they don't make you use it all at once. They might say you have a minimum draw on that home equity line of credit of $50,000. So you'll have to use at least $50,000 of that up front, but you could take out the remainder of that later on as needed. So you don't have to take it all out in one shot. And the beauty of that is, sometimes we don't know what expenses are going to cost us. So we start a project. You want to remodel a bathroom. You have to send your kids to school. You're not sure what it's going to cost for the semester in total, food and gas, and them traveling back and forth. You got to get a car. You don't know what you're going to need. So what the HELOCs, claim to fame is people are allowed to borrow money off of their house, keep it in a credit card essentially, and use it and pay it back as needed. Now, caveat to that, HELOCs are tied to the prime rate. So the prime rate is right now, I believe it's a 7.5 or 8%. So, the
rate's higher than a
rate is higher
mortgage.
than a regular cash out refinance or a regular mortgage, but they're not intended to be long-term products. However, they do have options for them. So what we were talking about at lunch was people right now, what we've been trying to get them in the habit of doing, and it's kind of being a little bit of a scar from the market that we were in prior. So before in the market, people were looking to sell their houses and they were getting in bidding wars, and they were losing out on these bidding wars to people because they had, some other people had $30,000, $40,000 to offer the sellers extra on top of what they were already offering for the house. So what the HELOC's allowing them to do is they have that ready available amount of cash to offer the sellers in this market right now. So right now, you guys know. Tell me what's the pace of the real estate market right now, Candace? Are you seeing any bidding wars or anything like that?
Honestly, so it's definitely not giving 2020, 2021. But the slowdown that we started to see, honestly, and it might be because the spring is starting to come back around, but I'm kind of starting to see things pick up. So something like this would definitely benefit a lot of people for sure.
Exactly. So right now, you might not think that you need that type of tool in this market, but we could very well be back there. One, because rates are coming back down. Interest rates last year peaked at about 7-8%. Now we're offering 5 and 6%. We're again, and what we estimated, we're hoping that they trickle back down into the 4. So that's pretty much average mortgage rates. Again, we were spoiled during the pandemic and everything like that, in the 2 and 3%. But average mortgage rate, we're going to fall in that 4 or 5% range.
What determines the minimum amount that you have to use on the HELOC? Because I thought you could have it just as a line of credit, but there is a minimum amount that you need to take out.
There is.
What determines that?
So it really is determined on the company that you use. So some companies' draw is $25,000. We have one vendor that we use that's $25,000. We have another vendor that we use is $50,000 minimum on the draw. But again, in the grand scheme of things, if you're borrowing $200,000, again, you're only paying back at the time that $50,000.
Right.
You don't start paying back the other amount that you borrowed until you actually use it.
Can you just not use it?
You cannot use it, but you're still getting charged the interest on that $50,000 that you pay.
The draw.
That's your initial draw.
The initial draw.
The initial draw. So you're still
for the length of the loan.
For the length of the loan. Now again,
how long? What's the timeline
on the HELOC? So most banks and most HELOC lenders out there, they're doing right now, it's a 10-year interest-only loan and then 20-year fully amortized. So you'll pay interest only for the first 10 years, and then that remaining 20 on the 30 year, again, you would be paying it back. Again, my advice to people, especially again people that are using it because they're not sure of what they're going to use it for, pay more in that first 10-year period. If you use what you need to use in that first 2 years, start knocking it off before you get to that 10-year mark. Now, the other thing that we were talking about using it for at lunch is people that needed to do home repairs to their houses to sell them. That's another big thing that we can get people in the habit of doing. So what you do is, if it's February now, you're looking to buy your house in August. Now would be a perfect time to get your HELOC. You can do any home repairs you need to do with your home with the HELOC money. And then when you sell your house so that it's in tip-top shape for a seller, for a buyer in the market and everything like that, you pay the HELOC off when you sell your house.
Is there a prepayment penalty on the HELOC?
On the products that we use, there is no prepayment penalty. There are vendors out there that have a prepayment penalty, and it's really going to depend on the vendor that you go through to obtain it.
Right.
But the vendors that we use don't have a prepayment penalty at all. So you could get a HELOC today, fix your house up within a month, and sell it in month 2, and there's no penalty for you doing so.
Right. That's an important thing to point out, guys, is that the mortgage company matters a lot, especially on the HELOCs, because there are different terms, right?
Yep.
So anything that we're talking about is things that Drew is familiar with or products that he has. Other companies might work slightly differently on timelines and the details. So this is why it's very important to talk to a professional so that you can get the details. And that's why we're having this podcast, because then you'll know the right questions to ask. Hey, what's the prepayment penalty? What are other good questions to ask a lender about HELOCs?
About HELOCs.
That's the difference between companies and stuff.
Yeah, big thing. Prepayment penalties is the biggest. So a prepayment penalty is, what you'll see on some mortgage products in general. And what that does is if you pay your mortgage off sooner than the bank or the investor allows, they charge you a percentage of money to close out that account because they're not getting the full return on their investment. So it's just like you borrowing $20 from your friend and saying, hey, I want it back in 20 years, but I'm going to charge you 30% interest on that, that $20 that I let you borrow for 30 years. But then if you pay it back to me sooner than that, I'm going to charge you an extra $100 for you to give me my money back sooner. And the reason being is they're not going to get that interest for the time period that they expected for that investment.
Mm-hmm.
Right. They might have made $500 from that loan, but now if you pay it off, they're only making like $3, so you got to pay a penalty for that. That's
exactly.
the purpose, right?
So again, prepayment penalty is huge. Again, that's on any loan that you do. FHA, VA, HELOCs. You want to ask if there's a prepayment penalty on any loans. Now, a lot of places prepayment penalties have been banned, but in the grand scheme of things, in the secondary market, there's still loans that have prepayment penalties on them.
Is a prepaid penalty generally more or less than the amount of total interest that you would have paid for the full length of the?
It's still less than the amount that you would pay on full term. Again, they can't charge you again because of the Dodd-Frank and everything like that. They can't charge you an extra exorbitant amount of money. So they may charge a 4% prepayment penalty on your balance.
It's still probably worth doing, but if you do something very, very, very short term and you could have probably just saved the money to do it, that's where probably it doesn't make sense to do the loan, basically.
Exactly. So again, if you look at, does the ends justify the means? Does me borrowing this money, knowing that I'm going to be able to pay it back in 2 years, but if I pay it back in 2 years, they're going to charge me 20% on the money that I borrowed.
Right.
Does that make sense to me, or do I need to find another vessel?